Tuesday, March 28th, 2023, Monaco 64, home of alternative economics and contrarian views. Today, we're going to look at financial repression. Yes, that's what governments and central banks and the banking system use to basically extract wealth from the producing part of the economy, from savers, people who have produced and been able to save some of their hard work. And it's a very nefarious mechanism, I would say. It's been done many times in the past, but people seem to forget about history, and that's what I'm here to try to help you understand today. So, financial repression usually happens at the end of a major debt bubble or after a major war, where governments get so much debt that there's no way to carry the debt other than just inflating it away, and that's what they do. But they need to keep the public from jumping off or out of the boiling pot of water, right? Just the analogy of the frog. They need to keep you in there until you die. Well, that's an analogy, of course, until your savings and all your efforts are extracted from you to them so that they can keep going, because that's what governments do best, unfortunately. They steal from you and they create havoc, like wars, pandemics, and things like that, right? So how are they doing financial repression now? Well, up until 2020, they were getting away with it. And I would say the financial repression has of late started in earnest after the '08 crisis. Yes, of late doesn't sound, '08 doesn't sound of late, but in the scheme of things, it is, in my opinion. And why do I say the '08 crisis? Well, because it was an existential crisis for the banking sector in the UK, in the US, in Western Europe. And if the banks had gone under, governments would have gone under, because there wouldn't have been any fiat currency for them to operate. That's how it works. So they were able to increase their balance sheets. And what do I mean by that? Well, there wasn't as much national debt for governments. Central banks didn't have that much on their balance sheets. I mean, the Fed had about 800 billion in assets, the Bank of England even less. And they were able to, and also governments, the national debt, they could increase it. So they threw everything at it, and they were able to keep the inflation, because it's all inflation. When you create all this currency and debt out of thin air, you manipulate interest rates lower. It's inflation. But you might say, oh, inflation has only started in 2022. No, it's been going on since 1971. And I won't go back into 71 when President Nixon detached the world from the gold anchor. But if you have been watching me, you know what inflation is. It's the excess creation of currency and credit out of thin air, resulting in higher prices, general prices. But since '08, they've been able to keep, up until 2020, that is, they were able to keep all this inflation going into financial assets like stocks, bonds, mortgage-backed securities, real estate, luxury goods, private equity, hedge funds. Yes, they inflated that whole financial bubble, and they did it again after the collapse of 2020 up until 2021. The people who've benefited from it, of course, have been the 1%, the very wealthy. But the general public is the general public's standard of living has kept going down, and now the inflation has actually seeped through to everyday goods that people need to survive, like food, energy, shelter, everything, labor. And it's going to continue to get worse because the powers that be, they need to keep this debt bubble going, because if it collapses, it will collapse very quickly because it's highly leveraged. The banks are up to here in leverage. That's why we're seeing the banking problem. And I think the banking problem in the small regional banks, the mid-sized banks, is just the tip of the iceberg. The real trouble is in the too big to fail with their quadrillion plus of derivatives, which is all balance sheet. But anyway, yes, we've seen the CPI rise into double digits everywhere around the world. And we're told that that is inflation, but it isn't, of course. And how does financial repression work, though? Well, it's happening right now because, for example, here in the UK, I'm going to give the example of the UK because the repression here is really bad. We have people like the Bank of England Governor Andrew Bailey saying financial turmoil will not affect Bank of England's push to curb inflation, says Bailey. Yesterday in a speech to the London School of Economics, BOE governor refuses to rule out further interest rate rises. Yeah, whoopee, Mr. Bailey. We've got trueflation in the UK, which is this set of data kept by this website at 16.06%. We've got the retail price index in the UK at almost 14% at 13.84%. And the retail price index was what was used as an inflation indicator or measure of prices up until the late 1990s. And then they switched to the CPI. But the CPI, even the CPI is at 10.4%. And they keep telling us that, oh, don't worry, CPI or inflation is going to be below the target of 2% by 2024. And can you really believe it will happen? Especially when you look at where interest rates are in the UK, and that's where the repression comes in. So the latest rise of the Bank of England rate took it to 4.25%. And if you look here, the average rate since the Bank of England was created is somewhere just above 5%. But since 1971, the average rate in the UK has been 7.12% from 71 to 2023. From 2009 till recently, 2022, rates were below 1%. They even got to around like almost 0.1. So we've had over a decade of artificially low rates. So what I'm trying to say here, even 7.12% won't do to bring back prices down, the rising prices down. And even if they bring the CPI down to 2% or they raise their target to 3%, you're still losing 3% of your purchasing power every year. That's what they don't tell you. They want you to stay in this fiat game. And they say, oh, don't worry, inflation is going to come down. No, inflation always goes up. Have you ever seen negative CPI? No, because they can't have it. Why? Well, because this fiat currency debt-based system needs to keep growing. And when CPI goes negative, which really it should, if you want to go back to where prices were back in, say, 2010, you'd have to see years of negative CPI, and they'll never do that. What they're telling you here is, don't worry, we've got double-digit price rises, but it's going to come down to 2 or 3 in a year's time. And they've been saying that for the last year and a half or two, that it's going to come back down to target, and it never does. So even if the Bank of England keeps raising rates, they're never going to raise enough to quell this inflationary pressure. Where should the rate really be? Well, it should be north of 20%. But seeing that the powers that be, the governments of the last 20 years, the central bank, the Bank of England, that's supposed to be independent, they've been running a massive credit bubble. So our economy has become a massive borrow and spend economy. So can you really see rates rising to 20%? So the people that this system favors are the big debtors and spenders, and government is the biggest one of them. It favors corporations that have all the expert accountants and tax experts to help them milk the system, to make sure they don't pay much taxes, that they borrow, they spend through expenses, and the people who suffer are the general public, who are only getting very little in terms of return on their savings. I mean, my savings account at NatWest has gone up, but it's only at 1%. Even if you're able to buy government bonds, gilts, they're below 4%, which is a joke, with the CPI running at 10.4. And they're going to keep doing that. They're going to keep manipulating it. And they're going to say that they're fighting inflation, but they will also fight financial stability, just like they did last year in September, October, when actually the banking system would have collapsed here in the UK as well. It wasn't just the LDI. Now that we see how the smaller U.S. banks are in trouble because of the rise in yields in government bonds. The government bond market here was melting down. Banks were going to be next, not just the defined benefit LDI scheme. So this is how financial repression is going to work. They're going to keep telling you they're on top of it. They're going to fight inflation while they keep inflating. Just think of it right now. The big corporations, the governments, they can borrow like at 4%, while the currency devalues by over 10, 12, 14%. So they're actually getting paid to borrow and spend, and a lot of consumers too are still getting paid to borrow and spend because the currency is going to keep getting trashed. And the only way to stop the inflationary pressure is to make it exorbitantly expensive to borrow, and that will deflate the system. People will default, go bankrupt, pay off debt, but that's not what they want because they need to keep going. So the people who suffer the most, of course, are people who have large cash balances in the banks, because they're getting nothing there, and even people who put money in the bond market. And if they do try to get a bigger return than 3 or 4%, 5 or 6, that's a very risky proposition. Now I want to talk a little bit about gold, because someone commented yesterday that in the UK, seeing that we think in sterling, that the strength of sterling versus the dollar affects the gold price, and it does. Of course it does. But what you need to understand is, and I've spoken about this and I've written about it even before I started making my videos here, like 10 years before, and I'll put a link to this article in the description. They're all sinking. Yes, you might see the pound rise like it has in the last week or two. And why has the pound risen versus the dollar? Is it because the pound is so much better than the dollar? No, the pound, the euro, and all the other fiat currencies, they're even worse than the dollar because they're a derivative of the dollar. But they're all sinking, as you can see here. So yes, the price of gold will be affected. Let's say gold doesn't move, but the pound goes up 5%. Versus the dollar, yes, the price of gold will go down 5% in sterling terms. But the way I see it is, why would you want to hold on to the pound? Because the pound has done even worse than the dollar since the beginning of the century, as you can see here. from incrementum. The dollar is lost 9.4% every year versus gold or real money, really. And if you look at the pound, it's lost 10.8, so it's done a lot worse. So yeah, I wouldn't worry about short-term strength in sterling. And even if I say that the dollar's days as a major reserve currency are numbered because of all the BRICS move towards their own kind of system, it doesn't mean that the pound will be in any better shape than the dollar, because the pound is part of the dollar system. So that's what I'm trying to say here. And that's why I think when you get these dips in the price of gold in pounds, which we did get at the end of February, and I bought some gold, that's the best time to keep adding on to, because financial repression is going to kill the value of your savings. And they're always going to find an excuse. Right now, they're saying it's because of the Ukraine war, but Mr. Bailey will never talk about the hundreds of billion of QE he did in 2020, and the fact that he cut rates to zero and kept doing QE up until late 2021. I mean, he raised the balance sheet of the Bank of England from around 400 billion to $1 trillion, which is kind of half the GDP of this country. So yeah, that's what financial repression is punishing savers to keep the debt bubble, the Ponzi scheme going. And they're doing the same thing in the US. And even the US CPI, we know that it's more like 15 or 16. This 6.4 or 6% number has very little to do with reality. So that's financial repression. With that, let's quickly look at where the markets are this morning. It's 8:35 a.m. London time. Spot gold is trading at 1955. It's virtually unchanged, it's down about $1. High's been 64, low 52. Silver is down 17 cents or 0.75% at 22.89. The Dow futures is up 94 points. NASDAQ futures down 6. S&P future is up about 6 points. So what happened to gold and silver yesterday? Why did they get hit hard? Well, it's just all the paper games, I would say, and algorithms. And as I said, a great opportunity to buy the dip. If you haven't been stacking, you know, this is a great opportunity, I would say. Just my opinion, though. To the currencies. Yeah, currencies have rebounded because the Fed reopened this daily swap line. So what the Bank of England and the ECB and other central banks do, they just print hundreds of billions of their currency and they give it to the Fed, and the Fed gives them all these dollars, and it's all off balance sheet as well. And what the Bank of England does, for example, they will sell those dollars to buy their own currency to make it look better, versus gold, to keep people in the banking sector, to keep you in the fiat currency. So right now, sterling is up a third at 123.25. The euro is up 0.25%, 108.28, and the dollar is down 0.4 versus the yen at 131.06. So let's go quickly through the other currencies. Aussie dollar is up 0.5%, 66.87. The dollar is down slightly versus the Canadian dollar, 136.36, and the Kiwi dollar is up 0.2% at 62.34. To the general commodities, we got platinum down $10 at 970, around 970. We've got WTI crude up 0.5% at 73.20. Brent crude is up a third, just below 78. High grade copper is up slightly here at 408.80. With that, I'm going to wish you all a very good day. Take care. Bye.